Hey, so today we're over here with Darren, our fabulous lender, and he's going to answer some questions for us about, getting ready and getting pre-approved and how to maintain that pre-approval. So, we don't screw this process up. We're all a team and we all have the same goal to get you into your next house. Hi, Darren. How's it going?
Hey, good morning, Dave. Doing well.
Excellent. Wow. Thanks for letting us invade your office today.
Absolutely. No problem.
And what a beautiful place this is. When people come to see you, they're going to be here at the Village in Meridian, looking at those beautiful mountains out there.
Yes.
Also here at the Village is great places to eat, get some coffee or some lunch.
Absolutely. Lots of things to do around here.
So true. And also, another great thing to do here is, apply for a loan. Or you can do that on the website too, right?
Absolutely. Yep.
Nice.
In person, over the phone, or online.
Man, technology is great, huh? Wow. So we're going through our different steps to homeownership. And today we're on step number 3, our financial situation worksheet.
Okay.
And if you guys haven't got your own copy of this, you can download it. We'll give you a link for sure. It's packed full with some great questions to make sure that you ask and things to consider yourself. So when you guys do start this home buying process, excuse my coffee, but it's been one of those mornings, right? That's the stuff of God's. So there's a lot of stuff that goes into buying a house, and obviously getting your budget figured out, because they don't want to buy something that is, like Dave Ramsey says, you don't want your house to be a curse, you want it to be a blessing.
Absolutely.
So to know that, you guys are going to have to figure out your monthly budget. And we have this great spreadsheet here that you can go to our website and get and plug in your own numbers. But one of the key things I want you to notice is down at the bottom, there at the left, is your goal, how much you want to save for your down payment. And then we tally how much that you've got in your savings right now. And then it also gives you the difference there, which is how much more you need to save up. So to get that first number, how much you need for a down payment depends on quite a few things. And that's why we've got a great lender, and he's going to answer some of those things. What goes into how much somebody needs for, getting into a house, a down payment, earnest money, closing costs, all these mystical things.
Yep. 20% would get you away from the mortgage insurance. But you can have as little as 0.5% of your purchase price. So $500 on $100,000. So it's down payment assistance.
Depends on the type of loan you're going to get.
Yep.
Okay. And we're going to talk about that more in a little bit. So there's other things you're going to need cash for too. And that's going to be closing costs. What do closing costs usually run?
Closing costs are 2.5 to 3% of your purchase price or loan amount, depending on purchase price or doing a refinance.
Now, do all these closing costs, can some of them be put into the mortgage so I don't have to come up with cash at the beginning?
Yes, they can be wrapped into the price of the home. So having the seller pay them, and then they would credit you. And
then that's going to affect how much I need to save up to get into a house.
Absolutely. Yeah.
Well, this is going to start to get pretty complicated pretty quick. Seems like what we need on our team is a lender.
Yeah, it helps for sure.
Right. So when you guys are starting this process, even as you're putting together your budget, having the right lender on your side is going to be hugely important. We've got a list of questions here that you could ask your lender, but I want to know from a lender, what are some of the questions people don't ask that they should be asking?
Really the process, I think. What is the process, how long it takes, what all they'll need to provide. Right. I know it's pretty upfront. We discuss it up front, but there's still that question of, you might feel that we're really intrusive or we're really asking for a lot. And that all comes down from the investors, the ones who purchase these loans on the secondary market. It's not our rules.
Okay, so the rules that you go by are dictated by several different things. Your investors.
Yeah.
If it's a government-backed loan, then I'm sure there's government regulation.
Fannie Mae, Freddie Mac, we have heard of them.
Sure. Okay. When let's say people get into the process and then they're so far into the process, they go, gosh, I wish I would have known this earlier. Do you know what, does anybody ever say that, and what are they talking about?
Really, no, I think it's pretty transparent up front. It's always really good to do a Zoom though, or meet in person, because when you're on the phone, it is tough for someone to capture all that information, because it is a lot of information. And me, I like to go into depth and try to help people understand.
Right.
Instead of just being real plain Jane, I like to go in depth, and so hopefully they have an understanding of why we're needing what we're needing and why we're asking for it.
So I think maybe that's one of the questions that we don't have on our list is the particular lender you're talking with. Are they going to be able to get on a Zoom call with you or meet you in person, and then just find out what's really important to you, and then not just respond to your questions, but to be proactive and come up with other things that you probably need to know that you don't even know you need to know.
Yeah, on that note, one of the big things is income, how income can be averaged. A lot of people think I make, however many dollars an hour, and I work this many hours a week, and that's how it should be averaged. But there's a lot of things that come into play previously, bonus income, a little bit of commission income, or self-employment. That totally changes the dynamic of income qualifying.
Very nice. Well, we'll talk about income in a little bit, but our lender checklist that we have in our book, this is for you guys to print out, make copies. So when you're talking to, if you're comparing lenders to lenders, you have a place to put down the information. So it's like when you're looking at houses, after a while, they all kind of look the same. So apply for a loan and get pre-approved. So this comes back to the different documentation for a typical loan that you guys are going to want to start putting together. Obviously, you're going to talk with your lender. Maybe different programs require different kinds of information, or maybe if you're a W-2 employee versus a small business person, you get paid on a 1099. Tell us what kind of things that you ask for documentation-wise to get this process started.
If you're W-2'd, we'll need 2 years W-2s from all of your positions. Potentially, if you switch jobs towards the end of the year, and leads into the next year, we'll want that last pay stub from the previous employer. And then 30 days of most recent pay stubs is the basics for the W-2 income.
That's pretty easy.
Yeah, that is easy. Yeah. Self-employed gets a little more complicated, but.
Okay. So if you're a W-2 employee, how long do you have to be a W-2 employee to qualify for a mortgage?
That goes into a bunch of different scenarios, because if there's job gaps, we have to take that into account. It can be as long as a year. It can be as short as first pay stub. So it just depends on the previous employment history.
Gotcha. So if I'm coming up from California, working for the same company or in the same field, then it's a lot easier, shorter time
absolutely.
frame.
That can be an easy transition.
And then if I'm a small business person, how long experience do I have to have in that small business role, 1099 stuff?
You want to have 2 years if you are making a move and moving a business. If you're clientele based and it's something that makes sense, like construction, you own a big construction business, where's your clientele going to come from when you start your business in Idaho? They'll look into that. But if it's something you can do remotely, then it's all computer based or whatnot, you can move wherever you want because you're remote. It's kind of the same with a W-2 employee if you're remote.
Right. Yeah. And I guess we learned how to do that during COVID, huh?
Yeah. It just has to make sense. Yeah.
Okay. Excellent. So I think what we're getting to there is that talk with your lender. Every situation is going to be a little different. And as long as it makes sense. I mean, you wouldn't want someone to loan you money you couldn't pay back, right?
Right. Yeah.
Well, unless you're the government, I don't know. So our different mortgage options, we have different types of loans. So how do you know what loan type that a person's good for?
Credit. So if we're not a veteran, we're not doing a rural development, in a rural area, then it comes down to a few basic things, and that's your debt to income ratio.
Okay.
And then your credit score. And credit history.
Right.
Plays into that.
Interesting. So if I have a good credit history and good income coming in, I might be able to go just conventional.
Yeah, then we'd be looking at a conventional loan.
Even if I don't have 20% to put down?
Absolutely. Yep. There's mortgage insurance we can get, and there's things we can do to help that not be so burdensome.
Okay. And just, back of the envelope, about what's the minimum amount with a conventional loan that I'd have to put down?
You can do 3%. That's the minimum down for conventional.
FHA's 3.5, isn't it?
It is. We can go less than that if we go with down payment assistance.
Wow. Okay. Well, down payment assistance, what does that mean?
That's just local agencies that have funds available, whether we do it in a second mortgage or a forgivable grant. And there's also free grant money out there too if you income qualify for that. So that's the few options where you can do closing costs and down payments. If you're in a situation where the seller won't pay closing costs,
right,
you can actually get that pretty much financed as well.
Wow. So the best way to find out about these, you probably keep up with these programs, right?
Absolutely.
Nice. So did you guys catch that? I mean, if you're like maybe a first-time home buyer or low income, there is help out there?
Really, you don't even have to be a first-time home buyer for the majority of the programs now.
Really?
Yeah. So if first-time home buyer means if you've owned a home in the last 3 years.
Okay.
So even if you owned a home 4 years ago and you come back into the market and have been renting for 4 years, you want to buy another home, you're a first-time home buyer.
Wow.
As far as the benefits to that, though, there's only a certain amount of programs and benefits that really help first-time home buyers. It's pretty straightforward these days.
That's pretty wild. It's like, I can't go there, but so you mentioned VA and RD. Why would people want to use one of those?
If you're a veteran, it's one of the best loans out there because of the things you can do with it, and the ease of getting a VA loan. If you're a veteran is pretty good.
Okay.
Credit score and debt to income, like I mentioned on conventional, you can stretch those limits a lot more than you can conventional.
If I'm a veteran and I've used my VA eligibility on, say, my current home, can I buy another home with
You
the
absolutely can. Yeah, that's something to discuss with your lender because there's some calculations involved.
Okay.
Depending on your scenario, you can absolutely have 2 VA loans.
Wow, that's pretty big. And we're in Idaho, so we have a lot of rural area. And so what's this RDA loan? RD loan?
Yeah, it's a USDA loan. It's for homes in rural areas, obviously. It's 100% financing is the big thing. It's a little tougher to do these days. You have to fit into their little box, but it is definitely an option.
So if you're looking to move out of the metro area into a small town 15, 20 minutes away.
Yeah, could be in Boise area. It could be as little as 15 minutes from Boise.
Wow. And the best way to find out if what loan works for you and what you work best with the loan is to talk to your lender. I see another one, reverse mortgages. And I understand, now the economy's changed a little bit, that more people are asking about that. Is that an option for people that have been in a home for a while?
That is an option, yeah, absolutely. It goes off the equity that you have in the home. You have to age qualify for it, and there's a few other stipulations that are in there, but you can literally buy a house with no payment. You can get into a home with the down payment and then not have a payment. So, great options.
Wow. That actually, there again, it could be great. Just talk with your lender because, there's, and then we have a construction loan. So we've got somebody that wants to have a house built. Do they have to have all this cash to pay the contractor up front, or what can they do?
Can get a loan for that. It's a longer, lengthier process, a lot more planning. If you own a lot, sort of say, and you want a builder to build on it, but you want to finance those costs to build that home, then that's just an easy construction loan. You can do it where you buy the lot and then do the construction loan and have a builder do all that. It's a great way if you have the resources to build your own home.
They have some programs, if I'm right, that you can get the loan one time and it covers construction and then turns into the mortgage?
Correct, yeah. One-time close loan, that's definitely available. And then you can also do a construction and then an end loan. There's benefits to both and pros and cons to both.
Okay. Wow. Sounds like a lender's going to be a key member on our team, huh? Firm up your down payment plans. So that could be come first knowing how much that you need for a down payment.
Absolutely, and that's where, once again, more time we have to plan, the better off we are. Start the mortgage process as soon as you can to know what programs are out there and have a plan, firm plan.
And I think you said starting earlier, that would also help if you need to, polish up your mortgage. Your credit rating, right?
Correct, absolutely. We can do what's called a rapid rescore. If it makes sense to get you to a 750 versus a 700, we have tools and resources to help do that.
So going back to your guys' monthly budget sheet, two questions for you. One is, when I have all this different kind of income, how do I make sure that it can be used by the lender to make sure, say I have a side hustle, and maybe I don't keep all that good of records with it. Maybe I'm out power washing driveways on the weekend or something. What do you need to see that I can use that income when it comes time to calculate?
These days, it's all what you report to the government. So what you report to the IRS is what we can use.
So if I have a side hustle that puts cash in my pocket, it doesn't really mean anything.
Nope, it does not, unfortunately.
But can I use that side hustle money for my down payment?
You absolutely can if it's seasoned. When it's seasoned, that means if it's been in your bank account for 2 months or more.
For 2 months or more?
Yeah, we go back 2 months when we look at deposits, when we look at bank statements and look for deposits on there. And then that goes into other things. How much was the deposit compared to your income? There's a percentage that we use.
Okay. So if you're in that kind of a situation, starting a few months out and getting all these things kind of in order,
yep.
Talking with your lender.
Best way to plan is have time.
Exactly. Those are some great questions there. Oh, some other down payment. A family member can help you out as well with down payment?
Yeah, you can use gift funds from a church, work, any nonprofit, family, close family. It can't be a long distant third cousin or something.
Right.
Yes, there's definitely those options as well. Okay. If you have the resources for it.
Nice. And then we have maintain your pre-approval. So in our booklet, we've got a long list of don'ts that you're not supposed to do because it could jeopardize. But some of them I wanted to ask you about specifically is be cautious when consolidating debt. So I'm looking at my monthly budget and I'm saying, gosh, I only have $1,000 more to pay off this, but could I put that $1,000 to something that would improve my credit score more than just paying off that?
Yeah, that comes down to one of those rapid rescore things. If you're talking improving credit score, it's not always I'm going to pay this off and then my credit score is going to go up. There's different factors that go into that. Paying something down to a certain amount versus paying it off could boost your scores more.
Okay.
It's kind of, you got to pay to play the credit score game is what I call it.
Probably you don't want to close any active cards you've been using.
Correct. That can hurt your credit scores because you have that history built up with that creditor, and if that goes away, that can hurt your scores.
So when I'm figuring out my monthly budget thing, I might think, it's natural to say that if I pay this off, my credit's going to look better, but it could actually hurt it.
It could hurt it, yeah.
And then this other one I saw was don't change careers while you're in this pre-approval process. What does that mean?
That can hurt things depending on the career change. If it's a W-2 and it's still kind of an admin or computer work or something like that, we could be okay. If you're going from 1099 construction to something totally different, or vice versa,
okay.
W-2 to 1099 contractor, that can definitely hurt you, and your waiting period could be 2 years, unfortunately, just like starting your own business.
But I like your first scenario, going from a 1099 to get into this house. Maybe I do pick up a W-2 job for.
Yep, we can do that too. If we can use it, that first month, first pay stub, then you're in a new career and you're W-2'd and income should be fine.
So, and obviously I'm a real estate agent, and I know some real estate, we're all 1099ers, we're all small business people. But if I haven't had a great year, maybe there was like a housing crash or something, I could go out and get a W-2 job, a regular 40-hour-a-week job, and then use that to get into a house.
Yeah, absolutely.
That would be smart.
Yeah.
But going from a great W-2 job and become a real estate agent full-time without any history of it, I'm going to be waiting a couple
That'll
of years.
hurt you. Yeah, and if you're doing a part-time gig to supplement income while you're building up your real estate business, we can use that, but we can't use the real estate business income.
And then I see another one here is don't shift around your finances. So if someone's got their money in these different pots, like maybe a retirement account and places like this, when they get close to closing, they need to have their money so that it can be wired to the title company. I've seen people at the last minute think they're doing the right thing and moving money. What's the really right thing to do?
It's really to just let it sit, or if we have time, it depends on how much time we have. If we've got, we're 2.5, 3 months out, let's get it into one account. Let's figure out how much you need, what you're going to use, and get it into one account. Last minute transfers are just a pain on everybody because we need that documentation now. We could be up against a tight timeline where we're having to come up with 2 months of bank statements for multiple accounts because money's moved around, and it just makes it real difficult on my team to go through line for line every transaction on a bank statement, especially if there's multiple ones. So once again, planning up front and having more time is beneficial. Takes away the headache.
Are you guys getting a theme here? It's like get started early.
Yeah.
Well, and let's ask about that is how early is too early to start talking with your lender?
No time too early. Yeah.
So it's going to be at least
a year out.
A year out?
Yeah, then we're absolutely.
They'll be golden because then you have time to make tweaks and improvements.
Absolutely. Yep. The more time helps for sure.
Well, and speaking of time, I'd like to kind of transition for a second into the cost of waiting.
Right.
So Darren, the cost of waiting. Interest rates are a little bit higher. I don't know if you noticed. Higher than they were 2 years ago.
That's right.
So do you know anybody that does know what interest rates are going to do?
Not exactly. We know they're going to come down. We don't know the time and how much. That's the big what if we knew, and then we'd be able to control everything.
But could they go up? I mean, so interest rates are kind of, 2 years ago we had a different president and interest rates are lower. So I'm thinking there must be some correlation between politics and interest rates.
I believe there always is, Dave.
Yes. And then we do have another election coming up, and it could go one way or the other.
Yep.
And that could impact. So if it goes one way, we might end up with lower rates.
Yep.
If it goes another way, when I first bought my first house, it was 13.5%.
Right.
So it's feasible we could go back up to that area.
I don't see it going that high. It would definitely crush the economy.
You are an optimist.
Things are slowing down with the rate hikes right now, and everything. The government always lags, right? They're always behind. So I believe we will be seeing them sooner rather than later. I believe could be like around the election,
right?
Could be sooner. But that's just going to bring out more buyers, and we're in an inventory shortage. So
I'm glad you mentioned that. So I did a little workup here, and this is just my layman's attempt at figuring out what houses are what it would cost if you waited. Darren's got a whiz-bang program that we're going to look at in just a second, but from what I put together, tell me if this sounds about right. Let's say we take a sample house of $400,000. And you put 10% down, your monthly principal and interest payments is going to be just shy of $2,400, and that's at 7% interest. And then if we waited a year and we still haven't had the election yet, it's still 7%. Just inflation, the cost of houses has gone up like 60% every decade for over 50 years, and so that means like 6% a year. So that same house of $400,000 would be $424,000. So just out of the get-go, you're going to be getting a bigger loan because the house is more expensive, and so your monthly payment's going to go up a little bit more. But let's say I waited 2 years because I'm going to wait for interest rates to come back down. In 2 years, let's say the interest rates are 6%, then it looks like a person could save $114 a month on their payment.
Right.
So that's, I mean, every dollar helps, right? But the scenario is that's 2 years away. House prices went up 6% a year, so that went up essentially for $49,440. I'll say $50,000 because I'm a real estate agent. And then you also spent, say, 2 years renting, so that would be like $2,000 a month. That's $48,000. So you spent almost $100,000 to save $114 a month, and you were still stuck in a house that wasn't maybe working for you for 2 more years.
Yeah, it's
and
not yours.
2 years you weren't building equity too.
Right, absolutely.
So are these numbers I'm throwing out there, is this just like wild stuff, or what do you say?
That is 100% accurate. Appreciation is a thing, and real estate's always going up and down, right? But you're still building that equity long term. You're paying down that balance, and hopefully it always goes up. Even if it comes down a little bit, you're still okay because you're still paying down that balance, and it's yours at the end of the day. And there's ways to accelerate that mortgage to pay it off sooner and all that kind of stuff. There's lots of tools and resources. Once you get into owning a home, you can use that as a vehicle to do a lot of other things. So you're not paying someone else's mortgage.
I heard Dave Ramsey say that if you get a 15-year mortgage, that it always gets paid off in 15 years, if not sooner. Is that true?
That is true, yes.
It won't go to 30 by itself?
Right, no, it doesn't go backwards.
Huh? And what about if I have a 30-year note, but I just like to have that little extra cushion in case bad times hit, can I pay extra every month?
You absolutely can.
Do people do that?
Yes, all the time. You're canceling your interest rate.
Really?
You're paying that off sooner.
So if I have an extra $100 this month, I can throw it to my principal.
Yep, principal only, and you're accelerating that mortgage. So your equity is going up faster.
And I won't see it now, but when I get further down, or if further into my loan, or if I actually sell my house sooner, then
you got more equity.
I'll have more equity.
Yeah.
Huh.
More resources to do things.
So the people actually have control over what their economic future is all about.
Absolutely. Yep. As long as you make your minimum payment,
right?
You're moving forward and putting yourself in a better situation.
So it's almost like you have your investment, and obviously you're going to maintain it, keep the leaves out of the gutters and a fresh coat of paint on everything, but also maintain the financial aspect. Pay some extra towards that principal.
Absolutely. Yeah.
Wow, that's so empowering.
It is. Yeah.
Nice. So back to this, the cost of waiting.
Yeah.
So one thing I didn't talk about is, rent is usually people have a year lease, and what do rents usually do over time?
They always go up.
And your principal and interest payment on your mortgage
stays the same
every time.
Yep, stays the same.
Wow.
Yeah. When you're in a lease, they're not going to come back and say, "Oh, we want to lower your rent."
So let's say we have a different president come in, and interest rates fall. You bought your house today. I could go refinance that?
Yeah, and we're going to help you with the cost of that as well.
Really? I'm renting. We have an election. Can I go to my landlord and say, "Hey, Donald Trump's president now. I want you to lower my rent"? How's that going to work?
I probably won't hear you.
Oh. You said something a second ago too about so we have this traditional inflation rate of 6% a year for housing, but you mentioned inventory is low.
Right. Yeah, inventory is really low. Even at the interest rate level we're at right now, people are multiple offer situations, overbidding for asking price, I should say, and paying more for that house just because of the lack of inventory. And if someone needs a house today, they have to find what they can find, and it might be limited.
That sounds like 2 years ago talk.
Yeah.
So if interest rates do come down, is that going to be a signal to buyers that giddy up, cowboy?
It will, and it's going to be a race to the one you want, and how much money you have to go over asking price.
So we already have low inventory. We have strong demand now, like you said. We have multiple offers, and then if you open that floodgate and more buyers come in,
It really really hurts things.
So instead of a 6% higher price for a house in a year, it could be because of the low inventory and a higher demand. It could be quite a bit higher.
Yeah, absolutely. Yeah, we saw it a couple of years ago.
So it's more of the high cost of waiting.
Right.
So you were going to plug in some numbers for us.
Yeah, I can plug in some numbers here. I'll just use the 400 again.
Alrighty.
And property taxes. A lot of homeowner associations out here will use a typical $35 a month. We'll go with, let's do 15% down, which would be 60,000. You obviously don't have to put that down. Like I said before, we have down payment assistance. Rates are more like 7% today. So here's our graph.
Wow, what does this mean?
We can go to, this is a little more number friendly here. Payment difference, if you wait 6 months, you're a couple $100 lower, but come year one, you're 24,000 in the red, which means you've lost that 24,000 in equity because of appreciation.
Yeah, but I saved my monthly payment.
Yeah, you saved your monthly payment for sure, but you're losing $47,000 year two, and you're $13 better a month.
Right, and of course your 47,000 doesn't include the amount that you were spending on rent.
On rent, right.
So if you're still a renter,
it's
closer to 100,000. But you're saving $13 a month.
Yeah.
Now, if Warren Buffett calls you up for financial advice, you gonna tell him how smart you are?
Yeah. And then here's just a different comparison of appreciation, amortization lost, and appreciation. Amortization is obviously the time you're paying down that mortgage versus paying someone else's mortgage. Your landlord's looking at this amortization schedule, and they're in heaven because you're paying it for them.
Sure.
That's why it's called an investment property. Total cost after year one is 24,000. So that's a chunk of change right there.
Wow. Yeah, just from waiting.
Yeah.
So we've been talking about scenarios with someone that maybe is renting now and doesn't have a house. Well, let's say that I do have a house. I've been in it for, say, at least 3 years. And now this house doesn't work for me. Maybe kids have moved out, or maybe we have kids, they moved in. I need a different house. Should I wait to get the right house for interest rates to come down?
Once again, if you're comfortable paying that higher interest rate for 12 months, 18 months maybe I would say would be the max,
But then I have my house for at least 3 years. I've got, 300,000 in equity in it, and I need to move into a house that works for me that costs 400,000.
Mm-hmm.
So I need a mortgage of 100,000. So that interest rate, whether it's 6 or 7 or 8, is it really that big of a deal on a monthly basis?
No, obviously the lower the loan amount, right? So if it's only $100,000, 7% versus 5.5% isn't going to be that big of a difference. And that's one of the things I would do is go over your whole, if you have that $300,000 in equity to play with, maybe you have a $600 car payment and it's $10,000 to pay it off. It might make more sense to just knock that out of the way.
Wow.
And that saves you $600 a month when your mortgage payment from 5.5 to 7.5 does not change at $600. So you're already ahead. It's one of the things we would look at.
Oh my gosh. So I can move out of a house that doesn't work for me, and I might be able to pay off the car, or maybe some of those medical bills that have been sticking around or something like that, and then get into the right house and
still save money per month.
Yeah. All right. So we've covered the first time, the people that are renting, people that need to get into the right size house. So it sounds like it's the right time to buy, even though the crazy market and interest rates and stuff.
Yeah, always, situational, and sooner the better, because you're going to start building that equity. and paying that mortgage down. That's just more money in your pocket.
Wow. It's pretty powerful.
It is.
I mean, so if you had your 25-year-old kid out there, what would you tell them?
Buy as soon as you can afford it.
Yeah, exactly. Well, and not to tell stories, but back when interest rates were 13.5 when I bought mine, I was single and I got 3 roommates.
Yeah, you can do that.
And I used their rental income as to help me get into this house. And so there are different ways of getting into a house.
Yeah, you can get really creative and make things work. So the first step, obviously, the more time you have to plan and talk to a lender. I mean, there's people I've been talking to for 2-3 years,
Right.
And waiting for that opportune time. Whether they qualify or they not, they're waiting for something to happen on their end, or we're waiting for something to happen on their end to qualify. So, yeah, it's never too early to get in and start asking questions.
And so that actually brings up a really good question is, are there things, everything being equal, right now is the time to buy. But are there things that are going on in someone's life that they should hit the pause button?
Absolutely, there is. Job change or just out of school, multiple things.
Don't know where you're going to live.
Don't know, yeah. Maybe you're just married and you're thinking about having a kid, but maybe not 100% certain you're going to have kids.
Right.
That could change your whole dynamic of where and what you buy.
Wow. So it doesn't sound like that many reasons. It's just so it's the uncertainty of like where you're going to live and what your financial future is going to be in the immediate future.
Right.
But once you get settled in, then there's no reason why. But let's say I'm going to only be in a place for 2 or 3 years, and then my kids are going to graduate BSU, then I'm going to move with them back to Arizona or something. Should I still buy for that 2 or 3 years, or?
Yeah, you can absolutely. I would recommend it. You can buy, and maybe if you want to, have an investment here. You can make that decision when you get closer to moving.
So I could buy a house and live in it, and then when it comes time to make that decision, I could maybe rent it out.
You can rent it out, hire a property manager to run it for you, and just have a cash flow.
Well, that could be smart.
It is very, very investment smart.
So we've covered people getting into the right size house that already have a house, people that don't have a house, and now we're talking about investors. And it is so I know investors, they go on whether the numbers work or not. And it sounds like there could be situations, maybe not for every investor, but that investing in properties still makes sense.
Absolutely, yeah. If you're going to use it as a primary residence and then turn it into an investment, your mortgage balance is lower, and you should have more appreciation. You got to think of it as your home is a vehicle, right? You can do multiple things with that equity.
Wow, excellent. And who's the best person that people can talk with to kind of figure all this stuff out?
Mortgage side would be me, and property side would be Dave.
Nice. Wow. Let's see. We're almost about done here, Darren. So what's your final thoughts on all this stuff we've been talking about?
I just can't stress enough the time. I know I've said it over and over. The time to plan. Plans do change, but then we can switch gears and readjust our plan, right? But getting into a lender and talking to them sooner rather than later to optimize credit scores, to get their bills and monthly expenses in check, bank account in check if you have multiple deposits from other sources of income that we can't use. There's just a multitude of ways to make things work with more time.
So time, but are you going to come across those people that didn't plan ahead and then come to you and go, oh, I fell in love with this house?
Okay.
Can something be done there? Or?
Oh yeah, we do it all the time. 30 days is your typical close time. You can hop on my website today and apply, and we can close in 30 days or less. So
wow,
we can do that too.
So if you do
makes it more stressful,
sure,
for everybody.
If you do have time, let's use the time.
Right.
But if something happens where you accidentally get house fever, get with Darren right away and start figuring stuff out, because he does it all the time.
Yeah, every day,
and it works. Wow, that is fantastic. So what's next in the process is we're going to be talking about things to consider about your next home. Just briefly on that, depending on your mortgage program, the house has to qualify, and meaning that you can't use an FHA to buy a fixer-upper. Am I right on that?
Yeah, correct. There are rehab loans out there. There's ways to fix certain little things, but each program, FHA, VA, and conventional, all have their different guidelines, what they'll accept for the home's condition. Conventional is the easiest, VA is probably the hardest, and then FHA is somewhere in the middle.
And I can't use a USDA loan in the north end of Boise.
Right, correct. Yeah, that's certain targeted areas, they call it. Yeah, that's that. It's all pretty straightforward. It's got to be livable. It can be as nitpicky as can't have flaking paint. Those are easy fixes,
right,
depending on the seller. And we can go out there and scrape some paint and spray some primer.
So another great reason to talk with your lender before we go out looking at houses, before you fall in love with the house. Want to know, what kind of house are we looking for, and also what your budget's going to be for the house. Not just the maximum that the lender says you can get, but what you guys are comfortable with, right, looking at your monthly budget.
Yeah.
I like it. Darren, thank you so much for being such a fount of knowledge and helping people out.
Dave.
And we're going to have all your contact information on this on this video, so people can reach out to you. So
anywhere we can help.
When you guys reach out to Darren, make sure you tell him Treasure Valley Dave sent you. All right, appreciate that. All right, well, thanks, Darren. We'll see you around. We'll see you at the closing table, and we'll see you guys on the next episode. Mind-blowing. Knowing your financial situation is just riveting. Just as riveting as when you click below to find out what a buyer consultation is all about. Or if you need to sell as well, to have a real live human research and tell you what your home is worth. Just click below and get that started. Now for a deep dive into things to consider about your next home, click the video button now. And if you'd like to watch our entire full on-demand buyer webinar for free, click the link in the description below.